Let's get officially started with today's webinar on social media and investing. Today, we're going to talk about fake news and how investors might protect themselves against it. We'll look at sentiment versus attention in social media posts and how investors might profit from understanding the difference. We'll explore the dangers of echo chambers when investing and share some tips designed to protect you. We have three exceptional panelists who will share their insights and experiences on these topics and more, and I'll introduce each in a moment. First, I'm Bob Schmidt, Executive Director of the Brandeis Center at UC San Diego's Rady School of Management. So yes, today we're talking about social media and its impact on investing, and we've got a lot of ground to cover. Before I dive in, I want to share a few announcements. First, I have to thank the team here at the Rady School for all their work in making today's event possible, especially Assistant Dean Wendy Hunter-Barker, Priscilla Morales-Salazar, the IT team at Rady, especially Chris Blanchard and Elise Grohl. We couldn't host these webinars without you all. Thank you also to Keshav Sharma, our Brandeis Center research intern, for all your work in promoting today's event, as well as the marketing team at Rady. And speaking of promotion, thank you to all my friends at Brandeis Investment Partners and Bridgehouse Asset Managers in Canada for your work in promoting this event. Also, thank you to Charles and Renee Brandeis. Really, it's their generosity and vision that make the Brandeis Center, our research, and events such as these possible. So a couple weeks ago, our panelists and I hosted a little prep call, and Will, who I'll introduce shortly, suggested framing the conversation today in this way. There are good things about social media, there are bad things, and there are ways to protect ourselves from the bad. Those are the three areas you'll largely hear us explore over the next 90 minutes. And having said that, if you have any questions or comments to share with any of our panelists, please just click that Q&A button and we'll do our best to get to you. We want to make this as interactive and conversational as possible. So yeah, on the one hand, social media has been really an amazingly powerful tool to affect change. Shareholders, others now have a mechanism to rally support, target management, raise awareness, whether that's on ESG issues, the Me Too movement, for example, or other specific shareholder initiatives. On the other side, companies also now have another avenue in which to engage with shareholders and other stakeholders. So there's plenty of other good examples of social media that I won't touch on here. But on the bad side, as we all know, there's a litany of things we could touch on, namely, to me, misinformation, the mistakes that people post online, and then disinformation, those who are intentionally promoting things that are false. So again, today largely we'll focus on the good and bad as it pertains to social media and investing, and then share some interesting research results, and then tips and tactics designed to make us more rational investors, and hopefully we're then less influenced by the bad stuff. So I've got just a couple more legal disclosure announcements yet, and then I'll introduce our panelists. First, we are recording today's event, and we will share that recording with each person who registered. We'll try to get that out to you later this week, but more likely in the next week or so. And last point on the legal side, we will discuss investment opportunities today, no doubt, whether that's asset classes or specific securities, but we are not, I repeat, we are not making any investment recommendations. Before you invest in anything, we encourage you first talk with a consultant or financial advisor. So having said all that, let's finally get to introductions, and let's start with Dr. Samantha Sito, Assistant Professor of Accounting at Simon Fraser University, just outside Vancouver. Among her research interests are investor judgment and decision-making and how technology affects those decisions. She will walk us through some research she's done on fake news and investors' susceptibility to different biases. Samantha, thanks for being here today.
Great, thank you for having me.
You bet. Next, my colleague at UC San Diego's Rady School of Management, Dr. Will Mullins. He's Assistant Professor of Finance. His research interests include whether social media platforms aggregate or generate information that's relevant to markets, or are they simply a sideshow? He will talk about social media sentiment and attention, the dangers of echo chambers, and even celebrity endorsements in just a few moments. So Will, thanks for joining us.
Thanks very much. I'm very happy to be here.
And our third panelist, Peter Gulliver, principal at the Gulliver Group, joins us today from Moncton, Canada. So we've got Samantha in British Columbia. We've got Peter on the opposite side of the country in New Brunswick. For more than 30 years, Peter and his team have provided investment management consulting services to high net worth private clients and select institutional investors. And I'll lean on Peter to share his thoughts from a practitioner's perspective. So Peter, thank you for being here.
Thank you for having me.
So, hey, let's start with Samantha. I'll ask her to take maybe 10, 15 minutes or so, walk us through her findings from a piece she co-authored on the value of a deliberative mindset. And then we'll ask Will to do the same with his work. So, Samantha, the floor now is yours.
Great. All right. So, like Bob mentioned, I will be talking a bit about social media in the markets and the impact of rumors, fake news, and firm practices on investor judgments from my research. And I'm super excited about this opportunity to share my work with you all and to share my research. So, as Bob mentioned, I'm an assistant professor at Simon Fraser University in the Beatty School of Business. And so I'm a CPA/CA professional by training. I went back to do my PhD in accounting at the University of Washington, where I studied judgment and decision-making of investors, auditors, and managers. And so my work today that I'd like to share examines typically from a psychological perspective, different aspects that impact investor judgments in the markets. And so the first piece looks at how company practices can affect investors' reactions. And the second piece is looking at the continued influence of fake news. And so I guess the overall motivation or groundwork for my research is the idea that technology and social media platforms have increased the spread of rumors and fake news. And so what we've seen is that there's different investment communities through Seeking Alpha and Twitter and Reddit. We've seen in the past years the rise of retail investor influence and how that can change the markets. And on top of this, what we hear is that firms have reported hearing a concerning rumor at least once a week. And so there's a lot of information that's being translated through these different platforms. And at the same time, regulators are concerned about the news that we see on the social media markets. And so the SEC has issued investor alerts to warn about this potential misinformation that we might see through engaging in these different outlets. And so regulators are warning individuals, investors about this, as well as financial professionals against sharing misinformation unintendedly. And what we've also found through prior research is that investors tend to overreact to rumors and fake news that they hear. And so, for example, Defonso and Bordia found that individuals tend to treat rumors as news, even though they know that this information might not be true. And other research from a broader market perspective have also found that prices of stocks tend to react strongly to this information, and it could result in abnormal returns, which then takes time to reverse, even after it's found to be inaccurate. So we've seen a lot of influence from social media that can influence the stock markets. And so my first piece of work looks at how a firm or a company's rumor response practice can actually impact investors' reactions to rumors. And so by rumors, what I mean is an unverified claim. So information that's uncertain and we don't know whether it's true or false. And I'll also look at the prevalence of rumors, so whether or not it has a positive implication for the firm or a negative implication. And then for rumor response practice, that's the firm's framework for responding to rumors. So when they encounter rumors, whether or not they comment on rumors, or if they may sometimes comment on rumors. And so I use psychology theory to look at how these different practices can actually impact an investor's reactions, so how the company's disclosure practices could impact that on a broader scale. And so one of the things that we know about rumor response practices is that we can learn about them in different ways, whether it's through the firm's previous responses or if it's referenced in an actual article. And so, for example, here, when Grubhub had a rumor that they were being taken over by Uber, we see that it specifically notes in the article itself that Grubhub had previously denied being for sale. And so this is akin to something like a discretionary practice where firms may sometimes respond to rumors. Whereas another type way that we might find out about these practices could be through the firm's official disclosure control policies or their investor relations policies. And so if we look into their SEC filings, we might see their actual policies where they say their policy is actually to not comment on rumors. And so this is something like a no comment practice that we might see. And this is often recommended by NIRI, the Institute for Investor Relations. And we see that from regulators' perspective, typically regulators may reach out to firms to respond and may not. And so we do see a lot of variation in how firms might respond to rumors. And so in terms of how this impacts investors' reactions, so I draw from theory on mental simulation, where when there is a rumor and uncertain information, that means that we might simulate what might happen. So we might simulate potential scenarios, and the information that we focus on will then impact our reactions to the rumor and our beliefs about the rumor. And so this would then impact the reaction that we might have to a rumor and how strongly we react. And so in looking at how different practices from companies might impact that, that's kind of the goal of this project. And so how rumor response practices can affect investor information focus. Well, first, if we do see this discretionary practice where the firm might comment on a rumor, then we might think of different scenarios, such as the firm perhaps denying or confirming the rumor. And so as we increase the numbers of possible scenarios, this might decrease our focus on the rumor content, which would decrease our reaction to the rumor. And so I look at these different practices to compare how investors' reactions might differ, and through using an experiment. So I recruit 240 retail investors and actual investors through an experiment platform. And I manipulate the rumor valence of whether or not the company is going to have a positive result or negative by winning or losing a new customer contract. And then I manipulate the rumor response practice, whether it's a no comment practice or a discretionary practice, where the firm either does not comment on rumors or may have occasionally commented on rumors. And so this leads to my overall predictions now. So predictions on the y-axis, that is the reaction to the rumor that we may have. So a higher amount would result in a positive reaction to the rumor, and a lower amount would be a more negative reaction to the rumor. And so I predict that expectations would be higher. And of course, if the rumor is a positive rumor, and expectations would be lower if it's a negative rumor. And so with the different practices that companies have, with a no comment practice in this dashed line, expectation then is that, of course, with the positive rumor, there'd be a higher reaction, and negative rumor, a lower reaction. And with the discretionary practice, this is when the firm sometimes comments that expected to be an interaction, a difference in reactions, where there's actually a weaker reaction to the rumor. Because of the fact that there are more potential scenarios to consider. And so when there's a no comment practice, we allow ourselves for imaginations to run more wild, and we would have a stronger reaction to the rumor. And so what I find is that having a discretionary practice mitigates investors' reactions to the rumor. So when companies actually respond to rumors, that this would result in, or when they have the potential to respond to rumors, they may actually have a weaker reaction. And further analysis shows that these rumor response practices can affect our information focus. So that's the findings from the first study, that a rumor response practice can affect investors' reactions through information focus. And this no comment practice can actually have unintended results of amplifying investors' reactions to rumors. So that's from the company's perspective. So the second study has to do with misinformation and fake news generally, and how we as investors can protect against this and be aware of some of the biases that we might have. So the first question is, well, does the effect of misinformation, which is fake news or rumors, does that actually persist? What happens when we encounter fake news? And if it does persist, if we do see this continued influence, how can we actually reduce or try to inoculate against this continued influence effect? So with this continued influence effect, the general basis of this is that Research finds that information will continue to influence judgments even after learning that it's fake. So if we first encounter a piece of news, this would often affect our judgment. But even after learning that the news is fake, this connection doesn't necessarily get broken, and it still actually impacts our judgments. And so our question looks at how can investors revise their judgments without introducing other opportunity costs, such as discounting true news. So if we're thinking about different interventions, in the past, psychology research has looked at different ones, but not in an investment setting. You could imagine that if we were to just become more skeptical of something, that would help us reduce our reliance on fake news. But then the problem is, from an investment context, if we're skeptical of everything, we could lose out on potential opportunities. And so we looked at this intervention, the deliberative mindset, which helps with breaking some of these links between our belief about news and how that impacts our judgments without impacting in a negative way. So this intervention of the deliberative mindset is a lens that encourages individuals to assess information in a balanced and impartial manner. So the key part of this is having more of a balanced mindset. And so how this can be activated is through a simple prompt that considers the pros and cons of an unrelated task. So it's a pretty simple mindset intervention where it doesn't have a direct actual implication. It's more of a reminder to yourself to think of things in a balanced manner. And so what we do in our experiments, we actually run 2 different experiments to test kind of the theoretical and the practical aspects of the deliberative mindset. And so we have the deliberative mindset prompt intervention and then an alternative prompt. And then we also use both true news and fake news to tease apart the impact of the prompt on both types of news. And so our goal is to test whether or not it reduces reliance on fake news while not impacting the true news. So that idea, again, of not creating this opportunity cost if it just causes you to disregard all news that you see. We also run a second experiment where we have introduced a control condition where we compare against what if you never read the news, would it actually put you back to where you were? And so our goal for the second study is to replicate our results and also to test whether or not this intervention could actually cause an overreaction if it would have a potential negative effect. So our findings from this first experiment, so again, on the y-axis, I have the change in valuation assessments. So that's your reaction to the news. And then we have our prompt and no prompt on the x-axis. So the first condition that we tested was the true news condition. So we did find that there wasn't a difference in the reaction to true news, regardless of whether you had a prompt or no prompt. And when we do test is that when there is fake news, that you would you would change your valuation assessment more when you have that prompt, so you would actually reverse that out. So the deliberative mindset reduces the extent that investors will continue to rely on information from the news article for fake news, but not true news. So the prompt does have that effect that we were hoping for. And then in our second experiment, we tested 3 conditions with that control condition. So we compared the idea of, well, if you've never had news, what would that difference be compared to if you were not in a deliberative mindset? So we do find a significant difference between those conditions, but we don't find a difference when you have that prompt condition. So what that means is that we replicated the benefits, and we also found that the deliberative mindset doesn't cause this overreaction. So by showing that when you've never encountered the news compared to if you did have that prompt, that your judgments are about the same, we're showing that the prompted its intended effect of basically erasing that effect of if you had seen that fake news in the first place. And of course, we are also showing that when you weren't in this deliberative mindset and you've later learned that news is fake, that there is that difference. And so we're showing the benefits of the prompt when there is this fake news idea. So our conclusion overall is that we did find this pervasive bias that investors continue to rely on fake news even after learning that this news is fake, which might be surprising considering that we have money on the line sometimes. And so what we tried to do then is to find this intervention, which is the deliberative mindset to reduce investors' reliance on fake news without then affecting the reliance on true news. And so thank you, and I'll pass this time on to Will to talk about his research and his findings.
Thanks very much, Samantha. Let me share my screen. Okay. Hopefully you can see it now.
Yep, looks great.
Okay, so my name is William Mullins. I'm an assistant professor of finance here at the Rady School at UC San Diego. And I just want to, I'm going to perhaps be sharing my ideas in less detail than Samantha and giving more of an overview of how I see the investor social media space. So just as a kind of as a roadmap, I'm basically going to talk about 3 points. The first thing is I'm just going to highlight that this is the new normal. This is a big change that has happened and is here to stay. And then I'm going to talk about some positives that come out of this, the bright side of it, and also some negatives, the dark side. So first thing, to set the stage, just investor social media is a new feature of the world that basically was born around 2010, 2011, 2012. We have, of course, X and Twitter. We have StockTwits, which is a version of that actually sprang from Twitter, which is kind of a Twitter for stocks. We have Seeking Alpha and the kind of notorious Reddit Wall Street Bets. These are the big investor social media spaces at the moment, although new types of social media are gradually emerging, like Discord investing servers. Now, the key thing here is that it is adding to the available information for retail investors. Retail investors do not tend to have a Bloomberg terminal. Those are very expensive and highly specialized. But now people can access market feeds, all kinds of information and analysis about these companies without working at a Wall Street firm. Secondly, there has been a huge increase, a huge jump in the number of retail investors. And these 2 pieces of the puzzle work together. So investor social media is generating information and retail investors are piling in to US markets. So here you can see, this is the daily net inflow, so the money going into markets from individuals, and looked roughly stable, from 2014 to 2020. And of course, 2 things happened. At the end of 2019, many US brokerages allowed trading to be free. And so many people opened brokerage accounts late 2019, early 2020. And then, of course, people were stuck at home during COVID. So being stuck at home, no sports, no gambling, a lot of people began to think about investing. And you can see there's a massive inflow of money, potentially, stimulus checks were maybe part of the equation. Whatever the reason, there's been a sustained inflow since then. So there's been a regime change. More retail investors are in this space. Now, what does investor social media mean in this context? Well, there are some advantages. So the very first and kind of obvious advantage is it's democratizing access to financial information. So as I mentioned before, in the past, you had to really be working at a bank to have access to this kind of information, especially kind of in real time. And now you can access all kinds of information about almost any firm that's listed on a stock exchange. In many countries, certainly in the US and in developed countries. But secondly, and this is where my research is more relevant, these investor social media platforms are producing new information. So I have a research paper which we can make available called The Social Signal. And that's a paper that really focuses on the question, is there anything really new here? Or is this just a repackaging of existing information that was already in the Wall Street Journal, that was already in the Bloomberg terminal? And what we find is actually that there is new information, that investor social media is producing highly specialized information for certain companies, in particular smaller firms. The smaller firms are not in, you know, the mainstream news outlets all the time. They don't have analyst coverage. And so now investor social media covering them is actually generating a lot of additional information that is useful for predicting returns. That's how we can tell if there is new information. If it predicts returns, you know, the next 5 days for the next 20 days, and it does, even after taking into account all kinds of other sources of information, like, you know, the preceding returns, like information from Google searches, like information from mainstream news, like Dow Jones Newswires, which includes Wall Street Journal. Above and beyond all of that, you can use the information from investor social media to predict stock returns. So what that's telling you is there is really new information there. And secondly, we realize that investor social media has kind of two components. One is the attention component. Just, are people paying attention to this stock on this day? Are they writing about it? Are they posting about it? And the other is the sentiment component. Are they bullish about this stock? Are they bullish or are they bearish about the security on a given day? And actually, interestingly, these two signals, the attention signal and the sentiment signal, move in opposite directions. So on social media, if the sentiment is positive, then that is a good sign and actually predicts positive returns over the next 20 days, as you'd expect. But social media attention, when you remove the sentiment component, is actually negative. It predicts negative returns going forward. So there is actually a subtlety to this. Just because people are talking about a stock doesn't mean that that's a good thing. It tends to suggest that there's bad information out there, especially when you take into account what the sentiment signal is saying. So these are two separate sources of information kind of being packaged into the same platform. And actually, we find some more interesting things. We find that the different platforms, you know, StockTwits versus Twitter versus Seeking Alpha versus Reddit, they actually produce different information. There is a different signal in each one of these platforms, which is actually not entirely surprising. These platforms have different user bases and they have different structures that generate information, different types of information. And so there is a common component. They do all, you know, tend to pay attention to the same stocks on the same day to some degree. There is a real correlation there, but the sentiment is actually very different across platforms, which suggests that there are different people on each of these investor social media platforms. And finally, kind of a final result in this paper, which I think is worth highlighting, is, you know, remember the investors that came out of this, you know, out of the COVID period. These investors actually have different information. These investors that when they trade, when they share their posts on social media, they are actually less informative about the future returns than these investors are. And to some extent, that is because perhaps they have less experience. We don't really know, but maybe it's because they are focusing on different types of stocks. So for the moment, we don't really understand why they're different, but it really does seem to be that they are different. Okay, so just taking stock, I've talked about the bright side of social media, at least two aspects that from the perspective of retail investors is actually very interesting. You know, more access to financial information and new information. There is, unfortunately, as Bob mentioned, there is a dark side. And, you know, if we think about the dark side, there are pretty well-established things to look out for, or concerns, when we think about retail investing, or, you know, investing by people who are not themselves institutional investors. So essentially, as humans, we have biases. And as humans, we tend to overtrade. And these two things can be exacerbated by investor social media. So, for example, I have a research paper with co-authors that shows that people's political beliefs in the US, so, you know, explicitly being a Republican versus being a Democrat, actually affects trading behavior of retail investors. And this is not a good thing. So people overtrade already, and the disagreement that the political beliefs are inducing among market participants. So, if I am a Republican and, I use that as a frame to guide my investment decisions, in general, that is not a rational thing to do. And similarly for Democrats. And we could see this, that people are using their political beliefs in their trading decisions. An even more kind of precise focus on biases is this other paper that I wrote with colleagues called Echo Chambers. And what that is focusing on is selective exposure bias. So in a nutshell, what we're thinking is, do people build their own echo chambers? When they choose what information to look at, where they get their news, do they use their pre-existing beliefs to do this? And kind of the intuition here is we suspected that this was going to be true because we know that Democrats tend to like watching MSNBC, for example, and we know that Republicans tend to like watching Fox News. And so we thought, what about in an investing setting where it's not about politics at all, where instead it's, let's say, I am a Tesla bull. Do I like to listen to and be exposed to other Tesla bulls? Or instead, am I a Tesla bear, and would I like to be, exposed to bulls who are giving me the opposite case? An echo chamber would be, as a bull, I only want to hear from other bulls. And that's what we find. Even in investing, when money is on the line, people try and kind of stay away from information that doesn't accord with their prior beliefs. And that's very surprising. You'd think that as money is on the line, you want to hear all the information about the stocks you care about. But instead, people build their own echo chambers. People systematically set up their news feeds so they're not exposed to things that disagree with what they already thought. And this leads to worse returns for the investors who do this. This leads to more trading for the investors who do this. And it's not just retail investors. Professional investors do this. They do it less, but they still do this. This is a deep human bias about, it comes essentially from how we process the world, how our emotions interact with our rational processes. People who are trading, we show that they do it twice as much. It happens even more on news days when you'd expect everyone to agree because the news had come out. There's less uncertainty about a stock, so there should be less echo chamber behavior, and instead there's more. And so, this seems to be a deep feature of all of our psychologies that we need to keep in mind and try and push against to the extent possible. Okay, final point I want to make, another dark side of social media, is it exposes investors to manipulation. So as Dr. Sito already mentioned, that fake news is one dimension along which investors can be exposed to manipulation. Another is a very early research paper that I have with some co-authors, which looks at celebrity social media. So, sports stars, TV stars, musicians, Hollywood stars, and we look at how they, what happens when they tweet about crypto. So, Kim Kardashian very famously posted, for example, on Instagram about Ethereum Max. And, that many people invested as a result, according to, the SEC. We look at this and we see, do people take celebrity posts about crypto, even though these celebrities are not financial analysts, are not known for their financial skills, they're, NFL players, they're Hollywood stars, and do they take it as if it were financial advice? And we find, and this is early work, but we find very strong evidence that people are responding as if it were financial advice. And so going out and trading and buying these cryptocurrencies. So again, classic case of manipulating investors through investor social media. Okay, so I think that's enough from me. As I mentioned, another way that you can manipulate investors via social media is the work that Dr. Sito already mentioned. But I think I will hand it over back to Bob, who I think will introduce Peter. So thanks very much.
Okay. Will, thank you. I've been taking notes as you and Samantha spoke, so I've got a bunch of questions I'll ask our participants. If you have questions or comments that you want to share, again, please post them in that Q&A section. But Peter, over to you as the financial advisor just given everything you've heard and maybe more focus on what you've seen with your clients, prospects over the last 10 or 15 years, how do you think social media has affected investors? And secondly, how has your role as an advisor changed? Any thoughts?
Yeah, thank you for the questions, Bob. I think over the past 15 years with the rise of social media and smartphones, I find the biggest thing that I notice that attention spans, instant gratification, people living more in their limbic brain, as opposed to 15, 20 years ago. I think that people did a lot more prefrontal planning, long-term problem solving. I see that people consume a lot of expiring information, like what happened, versus 15 or 20 years ago. I find that people look more at permanent information. They would read more books and try to build on knowledge, and that knowledge compounds over time. So the decision making was probably better because of that. I find that my role has changed. That I'm more of a coactive coach, and what I mean by that is that I have to be aware, like what my clients are consuming, how they're consuming it, sit down with them, educate them with different papers, maybe books to build on their permanent information that they're bringing in, and kind of circle back on some of their ideas and suggestions on how that fits into their aims and their vision for their policy statement. I don't know if that answers your question completely, Bob, but that's how the big changes that I've seen, like in the past, I would say 10, 15 years.
Peter, that's perfect. And if I heard you correctly, lower, maybe shorter attention spans among clients and more focus on what you call, I missed the word exactly, but I think it's
instant gratification.
Yes. And kind of temporary information versus more permanent knowledge, kind of fundamentals per se, maybe.
Yeah, exactly.
We'll talk a little bit more in a moment about how we might be able to counter that. I've got a bunch of questions here. I want to circle back with Samantha and the work that you did on companies and how they choose to respond or not respond to the rumors. Over what period did you look?
Yeah, so I guess my research is done in a theoretical lab setting. And so there isn't a specific period. It's more the initial of, well, when you encounter a rumor and this is what you think the company might do, how might you respond to that?
Got it. Okay. And how about, you mentioned information focus. Can you expand on that a little bit more? What is that exactly again?
Yeah, so the idea is I looked at what type of information that investors are looking at or considering in their investment decisions. And so I did that by asking investors to actually write an explanation of what they were thinking about. And then I coded to see what type of information they were more likely to be focused on.
Okay. And then the one big question that I had, are you comfortable talking through the prompt in the fake news work that you did? Because you mentioned that a couple of times. If they're prompted, then their response to fake news once they learn it's fake is different.
Yeah. So the prompt that I guess from a psychology literature's perspective, a deliberative mindset can be activated basically through having this balanced mindset. So the general gist of it is ensuring that you're thinking both pros and cons of anything. So the reason why we test it from using a unrelated task. So we don't have participants think about like what are the pros and cons of investing in a specific stock, is because we don't want to interfere with the natural thought process.
Right.
And so we actually have to think about like pros and cons of something like your goals. So if you're thinking about retiring, just thinking about pros and cons of maybe moving to Costa Rica or something completely different. But just to activate that, you're thinking both from a balanced perspective, and then that will carry through to your thought processes when you encounter information, to not just think a certain way.
Okay. So again, if I hear you correctly, as you're helping people get into this deliberative mindset, and I love that adjective, it's think about some goals for the future and pros and cons, maybe ways that you might achieve those goals, obstacles that might come up. So it has nothing to do per se with investing, correct?
Yes.
Okay.
Yeah, I mean, I'll say like, yeah, it's a cleaner way versus thinking about one specific investment, because then you might then anchor too much on thinking about something.
Yeah, and I want to get Peter's input on this too. Going back, I mean, 30 years ago, I was an advisor, and what I've seen over the last 30 plus years, to me, when you ask people like, how are you going to behave if the stock market goes down 20%? They're like, oh, I'll hang in there. I'll hang in there, right? And when that happens, like, oh, Peter, sell everything. So, Peter, are there things that you do to kind of put people in that deliberative mindset?
Yeah, and I've actually used like for purchases. I've actually used Samantha's. I haven't used her work specifically, but I do, when making decision, use the pros and cons, because it does make them step back to think about their decisions and to see how that fits into their vision. So I'll for the investment management side, I've always used investment policy statements to kind of make decisions, and for governance of the engagement of the investment portfolio. And one of the big things there is to interact with the client when building that policy, to make sure that they understand and know the utility of the assets that are involved in the policy. So and then bring it back into like the pros and cons, and kind of bring them back into using more of their thinking slow from Kahneman's book, to kind of step back on it. And another great book by Adam Grant called Think Again, just kind of step back from everything and to see how things fit into like the aim or the objective. So that's how I'm doing it. That's changed a little bit over the years. 20 years ago, I had policies, but now I find, stories have always been more powerful than statistics.
Right.
And now you have narrative economics, which is another great book by Schiller, that the stories are now being written to trigger those investment biases and the cognitive biases that we have. Yep. So to kind of educate people on that as well, that really look at the story. And I think Munger said it right: deliver to the world what you would buy if you were on the other end. And you have a lot of people that can write very good narratives.
Yeah. So thank you, Peter. And what I'm hearing here is the importance of having that deliberative mindset, of taking a step or two back and not reacting using, Peter, I think you mentioned people are more using their subcortex, not engaging that prefrontal cortex, not really.
Yeah, they're using their limbic brain, like the emotional side,
yes.
Which is, and I think that's another thing that's changed a lot over the years, like to not to become an expert in it, but understand what dopamine is.
Yep.
And how that motivates us to do things we think will bring us pleasure.
Yep.
And you shared with me a wonderful piece not that long ago, and that was very good. And I think we need to understand that and step back.
Yeah. Well, I'm taking a million notes here. Hopefully I get to everything, but remind me if I don't, to just circle back for a comment or two on dopamine. I'm certainly no expert, but I just want to share a couple things. But I want to turn to to Will, because you've got the easy one that I want to jump in on, and hopefully we can talk about politics without getting political. It's an election year. Let's talk about Republicans and Democrats, because I thought you were going to give us a little of that clickbait stuff and say, oh, well, this is how Democrats tend to invest and this is how Republicans tend to invest. But it's more so, if I heard you correctly, the news that they're consuming. And are they both groups showing kind of biases or tendencies based on their political leanings?
So that's a great question. I can answer it partially. So, based on the work that I did, which was really around 2020, and the period before then. So it was focused on how Republicans and Democrats reacted to COVID. Because remember, President Trump was president at the time, and there was a clear kind of narrative, and you could see it. You could see that the Democratic investors on investor social media reacted very negatively to COVID. Their sentiment collapsed. They became very bearish. And it actually mirrored what happened to the S&P 500 in March. February, March, you could see a big drop. And then the Republicans, by contrast, again, on investor social media, became very optimistic. And instead, their sentiment offset all of the negativity and were, just as optimistic as before. And you might think, that maybe there's just other factors that are at play that lead people to become a Republican or a Democrat that's correlated with this. But an interesting wrinkle, which makes it very hard to sustain that story, is this story about Democrats becoming pessimistic and Republicans becoming optimistic was not true for Chinese stocks. So stocks that were listed on US exchanges, Chinese ADRs, Republicans became extremely pessimistic about those stocks, very negative sentiment about them, whereas Democrats became, relative to Republicans, much more optimistic. And this aligns with President Trump's, at the time, very negative rhetoric about China and and his blaming of COVID-19 on the Chinese. And so, this kind of mapping so directly of Republican beliefs about stocks with their politics, and similarly for Democrats, is pretty strong evidence that people are using their politics to invest. And in general, there is a kind of a puzzle in finance about why there is so much trading. There is just an enormous volume of trading. And a lot of the bias literature tells us that individuals trade too much. We buy when it's expensive, we sell when it's cheap. We buy low, buy high and sell low, and that does not work well because we're trading based on our emotions, as Peter was mentioning, and we're definitely not using a deliberative mindset. And so, the fact that we are adding politics into this mix just worsens this. We were already doing things that were bad for our returns, and adding a political frame on top of our investment decisions is just not helpful as a general rule.
Yes. Now thank you, Will, and you mentioned that word sentiment on the political side, but that's also a term that you mentioned in your piece, the social signals. I just want to tease that out a bit more because I heard there's such an important distinction. So the attention is maybe the number of hits or tweets about a particular security, and the sentiment is whether it's bullish or bearish, correct?
Absolutely right.
Okay, so more attention is not necessarily a good thing. In fact, it's often a bad thing.
Exactly. So a lot of the previous research would just look at attention or just look at sentiment. And what we do is we say, clearly we need to look at both of these things at the same time. They're stuck together on a specific security on a specific day. And so what you need to do is try and tease out their separate effects. And in general, positive sentiment is good. It is reflecting good news about a stock, and it will predict that the stock will do relatively well over the next 5, 10, 20 days.
Okay.
But attention, when you take out the sentiment effect, actually predicts the opposite. It's bad news. So retail attention, investor social media attention, once you take out the sentiment effect, predicts negative returns.
Okay. One more question for you, and then I want to go back to Samantha. 5, 10, 20 days. Do you have a sense as to when that signal kind of decays? Because this is pretty short term for for an investment perspective.
Absolutely. We don't like to go so much further out, because the further out you go from each of these events, the more other things are happening. And so the less confidence you have that it's due to what you're looking at, and not just more information came out, new news came out. And so, it's just that the signal gets contaminated with the real world, with new events. So we don't see any strong reversals of this. So on average, so it could last for a lot longer than this, but we focus on the period that we can be confident that is attributable to these sentiment and attention effects that we're looking at.
Yeah. Speaking of biases, I mean, directing the brand to center, one of the things we tend to focus on is a long-term perspective. And our advisory board members, we've talked about social media over the years, and everybody is looking for a way to use it for more long-term investment horizons. So I don't know if any of you has any information on that, or maybe that's a research topic that we could take up at a future date.
It's a good question. I'm not sure. I think social media information is so high frequency by its nature that it's, I think, harder to think of it in terms of long-term investing.
Yeah.
If anything, it's maybe a hindrance to that, because it induces people to trade based on today's information.
Yeah, it's expiring.
Yes. Yes.
Right?
And
It's temporary. People have to act on it quicker because it expires. So
Yeah.
it triggers anxiousness. So it's it would be a very interesting topic. I'm not I know a little bit about that, but not a great deal. It would be a great topic.
yeah.
But I agree with Will there. I think it shortens attention spans. It grabs you because it is expiring. It's more exciting
Yep.
than
Yep.
permanent information, which requires more digging.
Yes. Yes.
And
And again, to be fair, brand to center focusing also on value investing and looking for those opportunities where there's a discrepancy between the price of a security and your estimate of its intrinsic or underlying value. And whether it's the stock market, the bond market, the real estate market, the supermarket, right? You want to buy things where the price is lower than your estimate of value. And it seems like so much of social media is kind of price focused and limbic, Peter, to use your adjective. So yeah, maybe we can do some digging on if there's a way to kind of integrate, aggregate some social media signals into more of a long-term thinking plan. So creating more work for us, mission accomplished. But I want to go back to Samantha, because you hit on something that I didn't appreciate when I first read your work, and I did a little research over the weekend on skepticism. And I know there's work out there that says, oh yeah, all you have to do to prepare or kind of ready yourself, make yourself immune to social media biases is just look at things with this skeptical mindset. But the dark side, to use Will's term there, is if we tend to look at everything with skepticism, particularly when it comes to investing, banking, our trust tends to erode. So we can't have a high functioning system where there's no trust. So in your work, you were able to put people in this deliberative mindset. So they're cautious about what they're reading, but they're not overly cautious about everything. Is that correct?
Yeah, that's correct. We specifically wanted to look for an intervention that could that wouldn't interfere with your overall thinking processes in a negative way, like you were saying, as we do see that a lot of brokerages and a lot of different social media platforms, sometimes they just add a blanket warning to say, like, maybe you should just think about this more carefully. And what prior research has found actually is these disclaimers could actually cause you to become desensitized, so you would ignore the disclaimer, or you would become oversensitized, where you're overcorrecting and ignoring everything that you read because you can no longer believe anything.
Yeah, yeah. How did you come up with that, with a prompt that would do that would help people on the positive side, but without making them so skeptical to everything that you kind of lose trust? How'd you do that?
I guess like we look from a theoretical perspective at this intervention. So this intervention has been used in different settings for different purposes. And so in thinking through it, we were just looking for something that would be more balanced. And so theoretically, we didn't expect this prompt to cause people to think negatively. And so that's kind of where we decided to test this and found what we did.
No, well, really, really well done. It reminds me a little, did work years ago with Dr. Frank Murtha, clinical psychologist, and he's worked in the investment field for 20 years, and we came up with this investor stress management plan. I think you can still get it through Brandis Investment Partners or Bridge House, but basically saying to investors, think of something that you can do over which you have control and it makes you feel good. And think of what that is before there's some market turmoil, because we know that's coming. We don't know what's going to cause it, but we know that's coming. And when it does, instead of reacting, using that emotion that's going to come up and selling or buying or whatever you're going to do that activity that makes you feel good, over which you have control. And then a couple days later, maybe take a look at the portfolio. And what we were trying to do there, similar to what you talked about, was do something that's unrelated to investing and kind of get you out of that investing mindset. And that tends to ground people a little more and helps them make better decisions. And it sounds ridiculous because it might be, bake a cake or plan a vacation or work out or clean out the garage. But it has been helpful. A number of advisors have come back to me and say, yeah, that's a great tool, but you have to have it in the quiver before. Like you can't bust that out, when stock prices are plummeting during COVID. Like I can't tell somebody to go clean out the garage. They'll think I'm crazy. But Peter, are there any other specific things that you do with clients to kind of talk them down, walk them back a little bit?
I think the biggest thing that I would do is just educate on decision making, whether it be papers, good books. Try to build upon that permanent information and have it compound over time. Which that's probably the biggest thing, Bob. Like just to educate, because there's so much information out there, and there are not a lot of models to bring that information into. And so I think I mentioned it the last time, like, knowing that tomato is a fruit is knowledge, but knowing not to put it into a fruit salad is wisdom. And try to build like on that wisdom through permanent information. And that's found in books and good papers, and to really incorporate an educational program now around the client, and to constantly be preparing them for that eventual market correction. I mean, that's one of the things that's permanent information. That's why history is so good. I mean, there's a book written back in the 20s by Frederick Lewis Allen, The History of the 1920s. And they talk about Seaboard Airline across the dinner table, and people buying Seaboard Airline, and the people thinking it was an aviation company. In fact, it was just a train that went from one distance to the other, and that was considered an airline. So like to read history and to build upon like that permanent information and try to stay grounded there.
Yeah. So are you dripping that more out on clients?
Absolutely.
Regular? Okay. Yeah. And that kind of ties to the coaching.
Yes. Yeah. And try to build, wisdom through books, or, I'm going to forget the actual quote. But there's an old saying, right, that it's better to take your time and to look at things than to do something and then have to fix it 3 or 4 times down the road. It's not a good place to be fixing things 3 or 4 times down the road. So to take your time before you plunge into anything. And
There's
to go back to Samantha's work on the decision making, the pros and cons, and always kind of keep it balanced and not to become too over optimistic.
yes. Well, there's a few phrases I can think of, like measure 3 times, cut once, or
Yes.
my favorite, ready, fire, aim. That's not what we want to do exactly
Exactly.
when we're investing. But hey, I want to go back to Samantha on one thing. In reading your paper, you had mentioned the continued influence effect and how its effects are apparent in other realms, like for a jury. Can you talk about that a little bit? Continued influence effect.
Yeah, so the continued influence effect, I think they like to describe it as the idea that you can't unring a bell. So you will always remember how it sounds, things like that. And it was found in kind of that jury law setting where if you have a lawyer ask a question and cast doubt and then it gets dismissed, juries still kind of have that in the back of their minds, that doubt. And so that's kind of where this body of research came from the jury setting and general psychology literature. And so what we do is we take this and see if investors still have that same effect, because we would expect that when money's on the line, that you would be able to completely disentangle all that. But we find that that's not the case. And even in settings with like auditors, this has been found in that accounting audit setting as well.
Okay.
And so professionals can also fall into this category of continuing to still believe something in the back of your head that something potentially could be true.
Okay. Okay. And maybe tying that to the work that you have in progress on companies and their response to rumors. So if I was listening correctly there, it's better for companies to be on top of those rumors and address them rather than saying nothing. Correct?
Yeah, that's, I guess, from what my study specifically looks at. Yeah, that despite the fact that you might think just having a consistent no comment practice across the board, I do find that when you sometimes comment, not so you don't have to respond to every single rumor that comes away, but just the fact that investors know that you might comment, that could get them to change how they might think about that rumor initially.
Okay. Okay. This is tricky. It's just when to say something and what to say. And Samantha's your comment about professionals reminds me of something in the work that you've done, Will, I think on novices and professionals. And now that I'm asking the question, I can't remember if that was in Social Signal or echo chambers, but maybe you can help me out.
Sure, it was echo chambers, absolutely. So yeah, we do, one thing that was surprising for us is to find that professional investors, people whose job was, many of them, for example, were financial advisors. They also exhibit this echo chamber behavior. They choose to consume information that is already in agreement with what they thought at the start, which is kind of surprising. You'd expect that a professional would know that they need to know everything, as much information as possible about their investments, rather than to kind of bunker down in a group of people who already agree with them.
Right.
But it's still there. It's still there for professionals. It's less large for professionals than for novice investors, but it's still there. It's also there for people who have their money on the line, who are actively trading, versus people who have longer trades in the past, but not actively trading at the time. So it is pretty surprising that even more money on the line, even being a professional, doesn't really take away this effect of this bias. I suspect it's pretty deeply ingrained in all of us.
Yeah. Well, reminds me of that line from Wall Street when Bud Fox, the broker, is complaining to his buddy about his losses, and his buddy says, "Well, it could have been worse. Could have been my money, right?" But still, that feeling lingers with you, whether you've got money on the line or not. Correct?
Absolutely.
Yeah. So this brings up a whole big issue, and I'll just throw this out, and anybody can jump in who wants to. Can investors protect themselves? you know these biases, even if you've read the reports. I've read Dr. Cito's work, I've read Dr. Mullen's work, I've listened to Peter, I listened to this great call the Brandis Center did, I know all this stuff. And then you get in that moment where a rumor comes out, some news comes out. Can we self-regulate? Anybody want to take that one?
I think that a person has to step back, and I think, reading, I'm going to go back to reading some good books like Thinking Fast and Slow by Kahneman, and to realize when you're in the situation. I think it was Nietzsche who said that the madness is in crowds. It's rarely found in an individual. So to stay away from groups and to do, just to kind of step back yourself and think like a scientist. And before you go into the situation, Samantha, I think you can talk about like heuristics maybe a little bit. I don't want to put you on the spot, but we make shortcuts in our judgments all the time, and you have to be kind of aware when you're in the situation of what the inherent biases are of the situation. And I think going back to that deliberate mindset, maybe have a document with pros and cons and kind of put that out before you enter into the arena.
Yeah, for sure. I think being aware of, like you said, the heuristics and biases in advance and trying to catch yourself in that through different reminders. Like I love what you said, Peter, with one of the things we say in our paper is like, well, you could just have a simple Post-it note, and it doesn't have to be anything fancy. Just a reminder that to not get swept out in the moment.
I think that's a great point. And I've seen these studies on checklists, whether it's heart surgeons or pilots. And if you've got a written checklist of things to do, even if you're super experienced, that checklist can help ground you, help you be more rational, maybe uncover some things that you might have overlooked in the moment. So yeah, a Post-it note, a checklist, these are some things that people can do, but it's so hard when you're caught up in something to have that self-discipline to take a step back and say, oh, okay, maybe I'm getting a little ahead of myself.
Well, I think you're right, Bob. I think that, self-management was always very, very important. But I would argue right now, in the time we live, it's very important to have like, I'll use your airline pilot, like the checklist, to actually have a script to follow before you enter in, right?
Yeah.
I know, I'll use the US as an example, like with some of your, like the Uniform Prudent Investment Act, right? And you would have to follow a script to manage like a pension plan or what you have, right?
Yep.
You don't use your own judgment.
Yeah. And you and I have talked about this over the years, the importance of an investment policy statement and kind of driving every decision back.
Yeah.
It's consistent with our philosophy, our beliefs, our process, our long-term goals, et cetera, et cetera, et cetera. It's just, again, it's hard to get people to do that. I've given hundreds of presentations all over Canada, the United States, and I will say to advisors I present to, you're in a unique position to really help people. At the same time, you can't succumb to the same biases. You can't be fearful when your clients are fearful. So you have to work together. So it's tough to do, but I think I'm hoping that sessions like this, where we're raising awareness of some of these biases and sharing some tips and tools for investors to use, whether institutional or individual, can help, can have an impact.
I think if I could just add something,
Yeah.
I think just being aware of the pull of an echo chamber is a valuable thing to keep in mind, and the natural technique that you could use in response is to seek out the counter argument. So if you're a bull, try and find what the bear argument is for this investment, and if you're a bear, find out what the bull argument is. I think kind of proactively looking for the opposing argument is perhaps a good idea to think about as well.
Yeah, this is the classic devil's advocate, right? Which my understanding comes from the papacy. When one pope died, they're going to elect a new pope. We're going to elect Pope Samantha, and there's kind of a consensus building, and then they form the subcommittee of cardinals, the devil's advocate, to advocate on behalf of the devil. Why shouldn't she be Pope? And if she can survive that level of scrutiny, then there's more confidence in the decision. So I totally agree. And that to me is one great reason to partner with an advisor or make decisions in a group. So you've got a number of people who hopefully are confident enough, have that psychological safety where they can speak up and share the countering view, because any group, whether it's a group of 2 or a group of 10 or more, is only as good as the ideas that get surfaced. So yeah, totally agree. Any other thoughts on that front?
I do. Something that you said earlier has been kind of going around my head that I wanted to mention. You said, how could social media be relevant to long-term investing or to value investing? For long-term investing, I'm not sure. But for value investing, there is actually a channel that I could see quite clearly, which is a lot of these value investing value companies aren't necessarily kind of mega cap firms. And in fact, social media is especially valuable if you want to invest in mid cap, small cap, and even micro cap firms. What it does is it allows you to surface information about these companies that's much harder to do otherwise, because they don't have analysts covering them. They're not in the news. And so I think it does actually allow you to do kind of a lot of fundamental analysis and to get extra information for these mid cap, small cap, micro cap firms that in the past was very, very hard to do. So that's one thing. And then the other thing is, once you have done that, once you have taken a position, it also gives you a megaphone to try and convince others that this is a valuable investment, which is below fundamental value. And that can speed, if you convince people, if you post your research, if you share your views on social media, that is a channel through which you can accelerate the revaluation of these companies, the increase in their value as people recognize this. So that is kind of a potential bright side. And of course, it's very contingent, but for value investing, I could see the mechanism potentially.
Yeah, totally agree. And these biases are what value investors look for to create the mispricings in the market. And then we're hoping that over the longer term, the market's going to become more rational and that price is going to rise toward the value that we see. So totally agree. And you bring up a good point. It seems, just at first blush, it seems like small mid caps would be a more fertile area for investment. But I wonder, does that still happen for large caps? The Magnificent Seven. How crazy are some of those? That's a debate maybe for another time. But Samantha, anything that you want to share on this topic?
Well, I think Peter and Will have a lot of great things to say. Right?
Okay. Hey, we've got about 15 minutes left, and I want to make sure we've got enough time to hit on anything for each of you that we didn't touch on to this point. So maybe I'll start with Will. Something that you want to share from your research, or something that's come up today, or even another research question that you have, something that we didn't touch on thus far.
So that's a great question. I think we've covered a lot of the themes that investor social media is a lot more varied than people think. I think I just wanted to emphasize that it's not the same thing to look at Twitter as it is to look at StockTwits, Seeking Alpha, Reddit, Wall Street Bets. In a way, Wall Street Journal and the New York Times tend to say roughly similar things. They're just reporting the news, because investor social media has a spin, has a sentiment, and because it kind of crowdsources what is covered. There is actually, valuable information on each of these, or different information on each of these. So I think there's going to be more research trying to kind of understand why and how information is aggregated differently on different platforms. And I think, we made the first step with our paper, so the social signal, but I think there's a lot more work to be done in understanding how platforms shape information.
Yeah, that's a great point. And have any of you seen research on more popular social media platforms and their influence on investing. Things like Instagram or Facebook, or maybe I should start following Kim Kardashian now. That's not going to happen. Anything on that?
So to my knowledge, there isn't much on Instagram because it doesn't tend to, attract a lot of investor talk relative to the other things that are on it. But I mean, I think Facebook, there's an interesting study, and I'm gonna misremember. So just the vague gist of it is that people tend to buy houses when their friends buy houses, even if their friends, are far away geographically. So the kind of the friend network through Facebook induces them to make house purchases. And so it is an investment, but perhaps it's not the kind of investing that you're thinking of. But that's all that I've seen that uses or all that springs to mind that uses Facebook.
Okay. Thank you, Will. Samantha, anything on the, and I'm probably showing my ignorance with social media. I use it less and less, and largely because of sessions like this, the Netflix special in 2020, whatever that was called, The Social Dilemma. I think I watched that. And I was like, oh my God, I got to turn this stuff off. But Samantha, any thoughts on any of this stuff or anything that we haven't hit on from your work that you want to bring to light?
Yeah, I guess like for your question about like popular social media, I think there's been more studies done on Twitter, and whether it's from how's Twitter create more information, and whether stock prices move more when Twitter is being used, or I think the other side of it is also the fact that companies are using social media themselves to disseminate information. And I think Will mentioned in his slides that, yeah, it democratizes access because now investors can actually reach out directly to companies. And some of my other work that I didn't highlight talks about how when companies use social media, how that can influence investors' decisions and judgments. And I think with the whole dark side of social media, there is that bright side that as investors, we do have more access than we have ever had before. And so that's something to highlight, that that is what causes companies to have some pressure to respond to comments, questions, rumors, whereas in the past it would be you would have to wait for a reporter to publish this news article the next day, right?
Yeah. I often think of for shareholders, the only way to approach management was maybe getting an item, a proxy item on the annual meeting, and it's probably going to be non-binding, and then maybe you have to go somewhere. And here I'm probably showing my age again, but yes, very much a two-way street where companies can communicate with shareholders and other stakeholders and coming the other way too. So yeah, great point. Peter, anything we haven't hit on that you want to hit? Or
No, I think I'll just circle back to what Will said earlier about the house purchase. And I'm going to bring the dopamine back into that. And I'm going to use Kim Kardashian's name again because Anna Lemke, like in her book Dopamine Nation, she referred to Kim Kardashian. Dopamine is the Kim Kardashian of molecules. Okay, so. Well, like I've had that actually happen to me. So indirectly affect like investment policy statements. And it's, I find that it's a constant now. It could be someone buying a house in the South, like to retire. And the client, like having conversations with clients on a regular basis, if that's anything that they would ever entertain. And the answer is no. And then a week later, withdraw 20% of the portfolio to buy a house down south because someone else did. So not realizing how that affects like the policy statement and the long-term and cash flows of the whole engagement. I see that on not a regular basis, but fairly consistent with people. Dopamine motivates us to do things we think will bring us pleasure. So a picture is worth 1,000 words. So if someone sees the house that someone's vacationing at and sending the picture back, the next thing you know, there's a house purchase.
Yeah. Yeah.
And that's a very interesting thing. I would be interested to do more research on that, because by no means am I a dopamine expert, but I think that you have to be aware of it now and how that plays into decision making.
Yes, yes. And that's the one topic that I wanted to circle back on, because Peter, the piece that I sent you, it was in the Guardian, and the
Yes.
point when I read that, and you nailed it, it's dopamine doesn't make us feel good. Like people think it's the feel good drug or the feel good whatever, but it's just, it prompts us to do something that we think will make us feel good. So if you're hungry, the dopamine kicks in and says, go eat a pizza, which could
Yeah.
make you feel terrible if you eat too much. And that's, I think, the issue with social media. And the other thing that you and I, Peter, talk a lot about is the comparison. So typically with investors, right, you've got your goals. You want to put your kids, your grandkids through college. You want to have a comfortable retirement, all wonderful things. And then you look at what the S&P 500 did. Hey, why didn't I get that? Or, my brother-in-law owns these stocks. But, now with social media, you can compare your status to billions of people around the world. And I think it's so hard to stay focused on your goals when you're distracted by, to your point, hey, they bought a house, we should be buying a house. Like, okay, is that in the plan, or are you kind of veering off course?
Well, I think you mentioned it on one of our chats, Bob, about a year ago. There's nothing worse than seeing your neighbor get rich. And the thing now is that we're all linked.
Yes. Yes.
And again, people only show their good side.
Yes.
So
Yes.
I mean, it's always been that way. So it's it, as you said, dopamine doesn't give us pleasure. It motivates us to do things that we think
You think, yeah.
will bring us pleasure.
Yeah.
And that book, Dopamine Nation, written by the same same person. Her name's Dr. Anna Lemke. I think she's a professor at Stanford.
Okay.
And that's the article that you had shared with me.
Yeah.
That's probably a very good book to read.
Okay.
And to some of her findings are to kind of do detoxes, to step back. So I think I'll bring you back into it, Samantha, when you're making like deliberate decisions and balancing, you might want to do a detox cleanse of the smartphone before those things, just to settle the mind.
Okay. Any other, like 5 minutes left. Any other closing thoughts from anybody? Everybody's looking kind of pensive. No?
So maybe in closing, I really do think that investor social media is nuanced. I can see sort of from Peter's perspective that it causes all kinds of noise in people's ability to think long term. But it is the new normal. It is here to stay. And it does have these features of crowdsourcing information about smaller companies and kind of allowing specialized or niche information to kind of come to light. So to some extent, it's a challenge, but it's also, I think, an opportunity. And I think kind of the natural inclination is to fear change. But and we're all human, and I share this, but I think we also should view this as an opportunity to, for example, allow new fund managers to come up who are there just because of talent rather than because they went to Harvard Business School. There are dimensions of this that I think could be quite positive, but there's a lot of research still to be done.
Indeed, and it's a tool, and I totally agree. It's the new normal. So how do you best use these tools? So hey, maybe with that, we'll kind of wind things up. We're getting close to top of the hour, and really, again, just want to thank our panelists, Dr. Samantha Cito, Dr. Will Mullins, and Peter Gulliver. Thanks very much for a great discussion. And I got to leave us with a few announcements, a few more legal comments. You know, just a reminder, we were discussing social media and investing. We're not recommending any asset class or security. And again, before you make any investment decisions, we encourage you to talk with a financial advisor. Also, the regents of the University of California and UC San Diego are not connected or affiliated with, nor do they endorse, favor, or support any product or service of Brandis Investment Partners, LP, or Bridge House Asset Managers. And just a couple of housekeeping things for the Brandis Center. If you're interested in joining the Brandis Center email list, contact me through LinkedIn or my email, RP like Paul, rpschmidt@ucsd.edu. I promise we won't inundate you. We'll just keep you up to date on research reports as they're published, and keep you in the loop on future events. And speaking of future events, we're planning a couple more panel discussions this year, one on artificial intelligence and investing, as well as one on private and public equity investing. So look for those later in 2024. So coming back to today, on behalf of everybody at the Brandis Center, the Rady School, and UC San Diego, thank you. Thanks very much for joining us. We hope to see you at another event in the future. This concludes our event for today. Thanks again, everybody.